My name is Charles Brown III, aka CB3. I'm a portfolio manager and financial educator, and I've been an investor for more than 30 years. As a portfolio manager, it's my job to keep our clients calm during difficult market periods. I did it in the crash of 2008. I did it in 2009 and 10 as a commentator for Fox News. And I did it in 2018 during the trade war scare. But 2020 was different. The pandemic brought a new intensity of uncertainty to all of us. When I began researching this week's show, I asked, how can I encourage them financially this week? How can I help them make their week more successful? That's why CB3 Live exists. We've been on 2 platforms in 2 cities with the goal of providing financial truth and a sense of calm about what's happening right now. Every week, I look forward to providing financial peace of mind to my clients and listeners. It's for this reason that it's a privilege every single time I start a broadcast by saying, from COVID, U.S. policy, and world economics to clarity. This is CB3 Live. Good evening, everyone. Glad to be back. It is Thursday, April 8th, live from Nashville. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad you're with us tonight. You heard in the opening video that I'm an investor just like you. That's why I do this program. Yes, I'm a portfolio manager. Yes, I'm a financial educator. But I'm an investor just like you. I have hopes and dreams and aspirations and ambitions just like you do. And we're doing this together every week on CB3 Live, looking at the markets, looking at policy, looking at COVID and other medical issues that challenge us in this time. And we're trying to make the best sense of it to make good investment decisions. I try to provide financial peace of mind and clarity. And as the video said, I always ask 2 questions, and I'll ask them of you again tonight. And if you have any things you'd like to ask me, just put them in the chat box here. How can I encourage you? That's the number one thing I ask. And how can I help you be more financially successful? That's what drives me and this program to be a success for you every single week. So before we start tonight, I actually have 2 matters of business. The first is to wish a happy birthday to my daughter, Kirsten, vacationing in San Juan, Puerto Rico. How about that? I don't think we've ever had anybody overseas watching us in real time, but I hope they're watching for the first few minutes. But don't feel like you have to watch the whole show, Kirsten. Enjoy the time with your friends and family. And the second thing is that I got a letter this week, and I usually try to cover mail when I get it. Hi, Charlie. I hope the recent flooding in Nashville did not affect you too badly. It sounded like it was devastating. I always like it when our listeners, show some concern for our well-being. So I left the snow and ice and high taxation of Chicago, and I have flooding and tornadoes in Nashville, but we like it here. He says, Thursday's program sounds like it'll be informative and chock full of data. Your charts are always helpful, but given the format, sometimes difficult to go back and study. Is there a chance you can publish the charts afterwards? And the answer is yes. cb3@cb3.com is my address. That's how you can find me. Just shoot me an email and say, hey, I'd like to get the slides from this week's show. I'll be happy to send them to you in a PDF format so you can read them. Obviously, you can watch the full video too. So this week, second quarter outlook, looking ahead with economic data and all kinds of good stuff for you. And then the year-to-date performance, and we're going to look at longer time frames too. This will be the most extensive performance review that I have given you guys. And we're going to do this now on a quarterly basis, okay? As the previous quarter ends, which is just did on March 31st, we're going to do a performance review. Reminding you, if you're new to the program, please subscribe to us on YouTube. Click the little bell so that you get updates when we go live or when we post a pre-recorded video like we do on Monday night. You can follow me on Twitter. I tweet every single day, sometimes twice, and also Facebook and LinkedIn, okay? The topics we cover every week: COVID, U.S. policy, and the world economy. And I have some people saying, well, I'm not sure I want to continue to hear so much about COVID, but there's actually some things going on that we need to keep track of because it infects, how about that for a Freudian slip? It affects our investments, okay? Right now, half of all U.S. adults have received at least one COVID vaccination. At least they will have by the weekend, and I'm in that group. I'm scheduled, I think, for the 28th for my second. About 63 Americans are fully vaccinated. Adults in more than 30 states are now eligible. So the age for requirement to be able to go in, it started at 75, then 70, then 65. And now pretty much any age in any state is eligible, provided, of course, the vaccines are available in that site. So what's encouraging to me, and that's why I'm continuing to have a COVID section here. We started this whole broadcast a year ago in March because of the COVID pandemic, but Vaxart is a new company that I'm mentioning tonight, and it's one of 40 biotech companies developing a COVID vaccine. What makes theirs different? It's an oral vaccine. So the U.S., this incredible bastion of entrepreneurialism at the small company level and the big company level, is basically not stopping for a moment. Even though we have Moderna and Pfizer and Johnson & Johnson, we have 40 biotech companies continuing to develop. I'm so encouraged by this. And what makes this such a great story is that U.S. ingenuity is what's driving this and gives us opportunities as investors to find innovative companies that are producing not just vaccinations for COVID, but other byproducts from that too. For instance, AstraZeneca, the European version of the COVID, basically has another country shutting them down. That's Australia, saying that you can't be giving this vaccination to people under 50. So they're finding problems with that. AstraZeneca is not the quality of vaccination that the U.S. vaccinations are, and this is why I have not invested overseas for your portfolios during this COVID crisis. I don't mean any companies, but specifically in biotech. What are Americans doing with their COVID checks? Well, they're spending about 1/4 of it, but they're saving the rest and they're paying down debt. Now, that sounds like, well, that's keeping money out of the economy. Actually, it's preparing for money to be infused into the economy later, once people get themselves more solvent. And I like that because anyone that has a high debt ratio is someone that probably needs to pay down that debt before they go on a spending spree. As Americans, we like to spend. As you well know from watching this program, 67 to 68% of our economy is driven by consumers. But I think this 1/4 spending of the stimulus checks and the rest being saved and paying down debt is a good place to be right now and bodes well for summer and autumn spending. The most dangerous variant right now is the COVID-19 UK or United Kingdom variant. That's the dominant strain that's entering the U.S. We're seeing some new hospitalizations, but it's actually very, very small. So regardless of what you hear on the news, what's the PI? Now you're going to hear me say this. This is a new little acronym. That's what stands for portfolio impact. What's the PI? Well, we have more vaccine choices. Americans are being prudent with their stimulus checks. The USA has quality vaccines that's clobbering the European AstraZeneca. The new COVID UK variant is having only a small impact here. So we are in the post-COVID era, and I'm very encouraged by that. So we cover COVID. The second area we cover is U.S. policy. And again, the only thing we cover on this program is what's going to affect your pocketbook. So how does that work? Well, as you likely know, the president and the Democrats are proposing a massive $2 trillion. I think it's going to eke up to $4 trillion at some point. But right now, $2 trillion infrastructure plan. And that sounds like a good idea on the surface, but if you really dig a little bit further and see where that money is going to be spent, it concerns me, and as an investor, it should concern you, and here's why. So if this breaks down, actually, I forgot to show you this slide. Sorry, this is the estimated vaccine distribution across the U.S. So you can see we'll be fully vaccinated by September. All right. And again, more reason to say we are in the post-COVID era, which is why I said that earlier. The reason U.S. policy is important is because politics is what drives policy, and Policy drives personal impact, and even more importantly, it drives portfolio impact. And that, of course, is what we address on this program. So President Biden has this $2 trillion infrastructure bill. There's a lot to read on the graph, but what I'm going to focus on is the infrastructure part of this: revamping highways, roads and bridges, modernizing transit system, airport terminals. These are all important asks, okay? That's where the federal government comes in and says, we've got this money available. Do you want to use it? The Nashville airport is going through a huge revitalization and expansion. I'm all for that. But these other areas concern me. Again, this is a financial program. Are we really, as investors, going to benefit from clean energy infusions? Why is the government getting involved in clean energy when that really should be done at the private sector? Renovating affordable housing, ramping up broadband access. This is not really something that I think the government needs to be involved in. The green area here: invest in home and community-based care for seniors, people with disabilities. Again, this doesn't sound like an infrastructure bill to me. So as an investor, as a portfolio manager, I just have to tell you the truth on this. There is a ton of, I'm sure you know the phrase, pork barrel spending in this bill that we, the taxpayers, are going to have to pay for, and I'm not really seeing the benefit. I'm all for the $650 to $700 billion that actually rebuilds roads at railroads and maybe even adds new roads. Bridges, obviously a big concern. I mean, we've got bridges that are 100 years old that are still in service. With all of these needs, why do we need to spend $2 trillion? If this concerns you, really the only thing you can do at this point, because there's no election until 2022, is write your congressperson and tell them, hey, we want this money spent. It's our tax money. We're paying for this. As investors, we want the money to go where it's going to benefit us. And I would encourage you to do that. I'm certainly doing that. I'm blessed to be in a state that's really conservative, and I'm pretty certain that our leaders here are going to do that. So it's this that's causing just some anxiety among investors. If you look at the chart here, back in December, people were pretty positive as far as the outlook for the U.S. equity market. 41 in favor, 29 not so positive. That dropped to 37 a month later, and now in March, we got 53% disapproving of that. It doesn't surprise me. It just doesn't surprise me, because the average American, regardless of whom they voted for, realizes that spending this much money that we don't have, we're already running a deficit. You're going to be adding this onto the deficit, which then, of course, pours over into the debt. And the reason that this is a problem is because the Biden administration and the Democrats are proposing that we raise the corporate tax rate. And I know that that's going to metastasize down to the personal tax rates at some point, although it's not in the news. But a 28% corporate tax rate puts us back where we were before the previous administration came in and lowered that to 21%. Okay? It just does not work. We're going to lose the benefit of the 2017 tax cuts. That's what has caused this huge expansion that we've seen over the last 4 years. Historically, GDP in this country has declined as taxes and government debt increased. I need to say that again. GDP growth, that's the gross domestic product. That's what drives our economy. That's what drives the companies. And the companies increasing in value is what increases our portfolios. That's why we're here. Okay, GDP growth declines as taxes are increased and as government debt is increased. Both of these are going to take place if this current legislation goes through as is. Another concerning fact, and I didn't see you last week, so in the last 2 weeks, Janet Yellen, the Treasury Secretary, she used to be the chairman of the Federal Reserve, but now she's Treasury Secretary. She's making a push for a global minimum tax rate for multinational corporations. So here we are with the globalists stepping in and trying to create a universal corporate tax rate. Do you know why that is? It's to discourage companies in the U.S. from picking up and moving to another country where they have lower tax rates. Okay, that's exactly what's in play here. So here are the questions to ask. Will the other nations or even our Congress be able to agree on a tax rate? Okay, what will the tax rate be? Will it include enforcement mechanisms? So if we say, okay, we're going to play by the rules, we're going to go to 28% taxes, and that means France and Uganda and every other country in the world, Russia, China, are going to abide by that. Do you believe that? What's going to be the enforcement mechanism, and will such a tax be effective enough to eliminate tax havens? This is my biggest concern on the policy front right now. This is the biggest concern I have as a portfolio manager, because there are signs from the IMF, the International Monetary Fund, that GDP projections for this country and other countries, but certainly for America, is now at 6.5% for 2021 without the infrastructure plan. So without spending the $2 trillion, we're on our own, again, letting free enterprise drive growth, not the government. On our own, should be seeing 6.5%. The message is clear to me, folks. We don't need egregious spending. We just don't. And we don't need more stimulus checks. I do understand that we need some infrastructure improvements. Frankly, the Trump administration should have gotten this done when they had control of the presidency, the House, and the Senate in the first 2 years. They got the 2017 tax relief bill. They didn't get anything done on infrastructure, and they should have. What's the PI? The portfolio impact. We need less and not more taxes. We want American corporate taxation to remain a domestic issue and not morph into another component of the globalist agenda. That's a lot. I'm going to say that again. We want American corporate taxation to remain a domestic issue and not morph into another component of the globalist agenda. What are these government loonies thinking? It's just not in our best interest as investors. I'm going to take a breath here and look over in the chat box. Any questions from you guys? Welcome to people. Hey, Karen, good to see you. Hey, Nellie. China will never agree to a global tax. They will not. And if they do, Nellie, I believe that it'll just be, they'll state it, but they won't abide by it. The same way Iran didn't abide by the terms of but that's another story. All right, so let's go back. Let's look at our third category. So there's a lot going on in the world economy. Obviously, we have first quarter earnings wrapping up. I gave you that data the last time we met. We cover 6 areas here. The weekly market review, which is going to be extensive this week. A featured stock, economic indicators. This is what I'm looking at that's driving the growth for the next quarter. Remember, that was the other point in the thumbnail. What's going to drive second quarter growth? I've got that for you tonight. What's the Fed up to? The housing market, and of course, the crypto corner. So the weekly market review, it's going to be more than just weekly. But before I get to this, I want to cover this topic. Read this over real quick, and then I'll get back on camera and just talk about this. So since we didn't have a show last week, we had this huge blow up of one of these large hedge funds in New York. Now, they call it Archegos, but really, if you look at it carefully, it's pronounced Archegos, and that's what's involved. And I've gotten 2 comments, again, and because I was off last week, saying, could this happen to us? Well, the answer is no, not a chance. So what happens with these hedge funds is they make a very, very highly leveraged bet, meaning they borrow money. Now, the Federal Reserve, because the interest rates are so low, is happy to loan broker-dealers money who in turn loan it to their hedge fund clients. We never trade on margin, okay? We do not trade on margin with your retirement accounts. It's actually not legal to do that. We wouldn't do it even if it were. Okay, but the leverage that was involved with this company that blew up was in the neighborhood of 20 to 25 to 1, which means for every dollar that they put in, there was $20 to $25 extended to them. Okay, so the unwinding of this capital management firm, they were forced to sell billions of dollars in investments. Why does that happen? Because a margin call, there's a very famous movie, if you can get through the language, which is really rough, it's an outstanding example of what happens when people overly leverage. So just realize that what we're doing for you on the retirement side has nothing to do with the kind of investments that are going on here with Archegos or Archegos, okay? They never even disclose their positions to, as a publicly traded company. So they're going down as, one of the wealthiest hedge fund managers in the world, literally within days was wiped out. So anyway, that answers that. Don't be concerned, okay? As of the 6th, because I'm marking the year-to-date performance on the 6th, the Russell's still the leader, 14.4 for the year. The Dow, the S&P, and the NASDAQ closing in. And I'm encouraged to see this. I've said all along, I tell you guys this every week, and I'm going to keep reiterating it, that in a secular bull market, we need to see all asset classes and all market spaces moving forward. It's okay if the Russell gets out front. Who was out front last year at this time? The NASDAQ was. Remember, we were just pulling out from the March 23rd low of the year, which I think is a low we'll never see again. I know I've told you that many times. So the Russell now is taking a dance. I mean, you watch programs, well, may I cut in? And then, they change dancing partners. That's essentially what's going on here. It's not a concern, all right? Not a concern at all. So I just want to remind you as I get ready to present the annual performance or the quarterly performance and then multi-years as well. The CB3 investment philosophy is to periodically evaluate the 11 S&P sectors and the industry groups and then select leading stocks from these leading industry groups from the leading sectors. Okay, what's the operative word in all of that? Leading. We want to participate in the momentum and invest where Wall Street is bidding higher. We don't fade markets. We don't fade the big players, okay? Thus, we and our clients want to share in that wealth generation process. That's the whole point, okay? And by the way, I saw that, Dr. J. Trading Places is a great movie too. I should comment, if you're an Eddie Murphy fan and you haven't seen Trading Places, it's not stocks, okay? It's about orange juice futures, which makes it kind of comedic because orange juice futures are among the least illiquid, no pun intended, meaning there's the least amount of contracts traded. And it's probably a 30-year-old movie now, but worth seeing. Trading Places and Margin Call. If you want to see two trading movies, and of course Wall Street with Mike Douglas, watch the first one. The second one really wasn't as good, but I digress. So these are our four programs, okay? Capital Growth, which we sometimes affectionately refer to as CG. It's aggressive appreciation. 33 stocks were 99% invested. Now, we may not always be 99% invested, but we are now. And again, when I report this quarterly, I'll let you know the percentage we're invested. Strategic Growth, consistent earnings beaters with 30 growth stocks and an ETF. Now, what does this mean? So it might seem like these aren't that different, but the reality is that I can trade in and out in Capital Growth throughout the quarter, and I do. In Strategic Growth, I trade basically 4 times a year, although I may swap out the ETF. What do I mean by the ETF? Well, you just saw the leading indicators between the Dow, the S&P, the Russell, and the NASDAQ. Last year, I had the NASDAQ in SG most of the year to give it a little oomph. This year, I've got the Russell in there because it is clearly the leading performer among the ETFs. So that's the difference between those two. Diversified Growth is all exchange traded funds. It's lower risk and it's multi-sector and industry. It also is 100% invested. The difference with this program is there are no individual stocks, so you don't have the risk of a stock blowing up with a horrible earnings report or a bankruptcy or something like that. And it allows me to go overseas and invest in Hong Kong. We're invested right now in Germany and Australia because I see opportunities at a country level without digging into an individual stock in a particular country. Okay, so that's what DG is all about. And then finally, Growth and Income, which is income-oriented stocks with ETF fixed income assets, also fully invested. We have been fully invested in our programs now for 3 years. There was a brief sidestep in 2018 in that pullback when I lightened a little bit for a few weeks, but then got right back in. But basically, since the night Donald Trump was elected and the market gapped up higher the next day, we have been 100% invested, and we did not sell anything 13 months ago at the March 23rd low. Nothing. And in fact, we actually were adding money for those of you that were wanting to add money when I had an opportune time. We were doing that in late March and early April. Those of you will remember that, okay? So how does this look? This is where we are as of today. So I'm going to sit on this screen for a while so you can take it in. You're going to get used to seeing this 4 times a year. So what I'm doing is I'm ranking our 4 programs in green and then the other indices that I follow. Now, there's an additional item in here, and that's the Vanguard Balanced Fund. So that is, when you see that, balanced means there's a percentage of stocks and a percentage of bonds. that doesn't really count for CG and SG and DG because those are fully invested equities. The only program that we have that has any bonds or any fixed income component is GI. Because, as you know from a previous writer that wrote in here, I don't like bonds right now. I recognize that there are opportunities in preferred stocks, in short-term paper. It's maybe some in high yield, but long-term bonds, we're just not there. We're just not interested in them. I think they are high risk, and I think that they are due for a major pullback. Equities are by far our favored asset class. So obviously, when you have the year-to-date, 1 year, 3 year, and 5 year, you have to choose which is the most important one. And so, in my opinion, the reason that I show 1 year in green is because 1 year is more indicative of my performance and how the decisions are being made than year to date. And why is that? Well, think about it. Here we are in April, and that's only 4 months. I mean, I've made some mistakes this year. I've done some smart things too. But if you look back a year, that should really give me time to do things right. So obviously, once we get to October, November, December, then the year to date and the 1 year should be pretty close in their actual numbers, performance. So strategic growth, capital growth, just absolutely killing it at the 1 year level, beating the Russell, the NASDAQ, the S&P. Diversified growth is trying to match or beat the S&P a little bit. You can see that the 1 year is doing pretty well on that. S&P, we made some changes here in the 3 year mark on diversified growth because we were lagging, but we caught up. Obviously, you can see now where you see the dashes on 5 years. That means that particular program has not been around that long. It hasn't been around long enough to have 5 years. We have had other programs that we did not continue because the strategy that I developed was not working to a way that was satisfactory to me. So when that happens, we stop that program and we develop a new strategy and pursue that. But that's what it is. That's the 1 year, the 3 year, and the 5 year. You'll see that growth and income actually is doing quite well for the year, actually even beating capital growth. The reason for this is, and I've been telling you guys just moments ago and every previous episode for a while, but I'm not a fan of bonds. We really flushed out a bunch of fixed income investments because they just weren't performing, and I just gotten tired of waiting to see them turn around. It's a good thing that I did. I mean, sometimes I hold things too long. I'll be candid with you, but I don't want to overly trade the assets in the programs. But I think it's important that you know how we do this. Now, for those of you that have been with us for a while, you might know that Capital Growth is our longest running program. It has almost a 10-year track record. So I highlight it at the 1 year, the 3 year, and the 5 year, and the 10 year. So even at a 10-year mark, and there's an asterisk there because it won't be a 10-year track record until I think October 18th. So 2 more of these presentations, and you'll see an actual 10-year verifiable track record. But we're keeping up with the S&P, even though, frankly, I made some not great decisions in the early years there, and a few bad decisions can get you off by 0.3% there. But we certainly have kept up with the S&P. We're beating the Dow over 10 years, so I'm encouraged by that. So do you anticipate C&G growing more this year? Absolutely, positively. Nellie, is the question. I mean, that's our goal every single year. I don't think that SG is going to supplant it. Again, if you look back at the performance numbers, CG has been more consistent. It's obviously a longer running program too. So, all right. So why am I so bullish? Well, here's a reason right here. Pretty simple to see. We have 11 sectors, and yesterday, all but 3 of them hit new lifetime highs, new closing high. Look at the green check marks. Now, there are some sectors that hit new highs. That means intraday highs, but not new closing highs. Energy, of course, hasn't. Utilities and real estate. What's important about this is the sector names. So I'm going to go back to this screen, but I really want you to key in on this. It's not just enough to have 8 sectors winning. It's the sectors that we care about. You guys know that I believe that diversification is worsification. For the most part, I don't invest in utilities and real estate and consumer staples. And I do invest in healthcare, but generally in the most aggressive, I guess you'll call it, or the high profile, the biotechs. But if you look at this chart, the sectors that are doing well are the risk-on sectors: infotech, healthcare, consumer discretionary, communication services. Okay, this is a big deal. Even though consumer staples also hit a new closing high, it's just it's a very positive sign for the continuation of this secular bull market. Bear markets since World War II. I continue to get emails saying, we just can't keep going up. We can't keep going up. Well, the reality is the last full bear market we had, look here at October 07, all the way to the right. That's the deepest one that we've had, and we've basically been pulling out of that ever since. Now, you can argue that, well, didn't we drop 36%, March 23rd from the February 19th high last year? We did. But that bear market is going to have an asterisk because it's going to be tied to a 100-year pandemic. And I believe it's going to have an asterisk in the record books. I really do. I don't think it's going to be counted as a full recession. We'll see how S&P, that's who makes these rules, and Dow Jones come up with actually labeling this. But I think this bodes very well for the continuation of the secular bull market. I showed this last week and had a few comments on it, and I want to just read it again. The most important quality for an investor or a portfolio manager is temperament and not intellect. Guys, remaining calm and cool during all of this is so important. So our featured stock is Google, also known as Alphabet. Who knows why they changed their name? We bought this in CG at $14.20. 2 days ago, it was trading $22.54. That's why I have everything marked here at April 6th. Almost a 60% gain in this. You guys know who they are. International technology giant. Various businesses. They've expanded. Obviously, they started as a browser company, but lots of different business units within there. They have various services and technology, and one of the analysts that I follow, and so what does this mean? So I don't make all decisions. I mean, I do make all decisions, but I have a lot of different people on the technical and the fundamental side that I consult to make decisions, not just to buy, because it's easy to buy a stock. I'll tell you what's tough. It's tough to hold a stock, and it's really tough to sell one. Why? Because it's emotional. That's why I put the Warren Buffett piece back in there for you, okay? One analyst I follow uses a relative valuation model to estimate the price of each business segment, and his target is 2,800. Look up there and you'll see we're trading 22.54. So we've got about 40% above the current price potential, and that's why we're holding Google in CG. Economic indicators. So what we're looking for here, again, in the opening thumbnail, it's like, what am I using to make decisions for purchases in the second quarter? What am I looking for in the way of these economic indicators? Because economic indicators, just like politics translates into policy, economic indicators translates into what's moving the economy, which is generally speaking what's going to push these companies. Obviously, their own productivity and creativity and making of widgets pushes them, but certainly favorable economic conditions helps a lot. Last Friday, when the market was closed, actually on Good Friday, the U.S. economy added 916,000 jobs, just short of 1 million. Just incredible. And the unemployment rate fell to 6%. Now, we had initial claims today, which actually was a little bit higher. So you might say, well, how can we have a gain of jobs, but then the weekly number, we have an increase in the number of people filing for unemployment? And it's because it's an uneven recovery. I've been saying this for more than a year now. We're going to have an uneven recovery, and people in sectors and industries that are not going to work are going to need to retrain, or they're going to be forever on the government dole, which I don't think is what they really want. All right. So the key takeaway from both these reports is that because there was more recent, meaning today, disappointing news from the Labor Department, the Federal Reserve is not going to make any changes. We'll get to the Fed in just a few moments. Consumer credit increased. The key takeaway on this is that revolving credit expanded for only the second time in the pandemic. It means people are paying down credit and they're building it up as far as building, credit strength for when they really want to spend, which is typically in the summer months. I think we're going to have a fantastic second and third quarter. And then, of course, fourth quarter, if there's, big Christmas spending, that'll be strong too. So what's the PI on this subsegment? Portfolio impact. All the stats that I'm showing you are just fantastic. And there are more, guys. There are just more here. Real simple graphs. Look at ISM services. The survey was for 59. The actual was for 63.7. Record high. And this is the Institute of Supply Management Service Industries. Real simple graph to see. All-time high. New business orders and business activities, new all-time highs. This is in a pandemic, guys, just getting out of a recession. Fourth quarter GDP, domestic product from a year ago, looking at going forward, the light blue bar, that's the estimate of the 6.5 to 6.25 that I mentioned earlier to you. You can see it dwarfs any GDP. Yes, that's correct. During Republican administrations too. All right. Dwarfing any of that. And the reason I say that is because I really don't want to seem partisan on here. The market is going to do what the market's going to do, driven by earnings. Companies' earnings are what drive this economy, okay? And I'm sure that every politician that goes through the White House or the Congress or the governorships, for that matter, wants to claim, responsibility for affluent times, and they hide during bad times. But the reality is, the market makes its own mind up, and we need to follow where the money is flowing if we want to make money in the market. Okay, more good economic data. Job openings, almost a lifetime high. Survey was 6,900 for the most recent report. Actual 7,300. And look at this one. Healthcare and social assistance just blowing it out of the water. 20-year high for open job positions. I mean, the reality is here, there is just all kinds of opportunity. However, as I said just a few moments ago, there could be some retraining necessary for people. All right. That's just what happens in a fluid economy. My grandfather, I think I've said this before on this program, in 1906 had the best job in our hometown, Fort Pierce. He was working 7 days a week. He couldn't possibly lose his job, had the best job security. He was a telegraph operator. How's that working out now? It's not. And that's because economies change. And we have to, as Americans, adapt. This is a cataclysmic event that has happened here. And that's why we have this program, to let you know that I'm monitoring the changes that are going to become investing in post-COVID America. All right, the Fed. I mentioned the Fed earlier. Basically, not a whole lot going on here. Jay Powell had a press conference this week. Not too much saying, although he did say, we really want to see the 10-year yield not get any higher than 3%. The last time that happened, it resulted in a 19% correction in the S&P. I don't think we're in that environment now. And the minutes from the FOMC meeting, so he's the chairman of the Federal Reserve, FOMC, Federal Open Market Committee. They have a meeting and they talk about, what we're going to do to help stimulate. They're waiting to see, of course, what happens. This is a chicken and egg situation. What's going to happen with the Biden administration and this 1.9, we're going to just call it $2 trillion relief package. They're basically saying, well, it could be a good thing. It could improve the position of small businesses slammed by the pandemic. It could boost consumer spending and contain some long-term damage in the labor market. Remember, full employment is one of the directives of the Federal Reserve. So what's the PI on this segment? What's the portfolio impact? Lower interest rates almost always is better for investments. And I say almost because if you're trying to retire on a savings account and you're getting 0.2 or 0.3% in your CD, you're probably not too happy now, but candidly, you shouldn't be in a CD. If you're trying to, at least not all of your money, if you're trying to have it grow, it's just not going to do it. So low interest rates are good for business, they're good for consumers, and they're good for our investments. All right. So on the housing front, nothing much here except just continued great news. This is a cool slide. The percent of existing homes that sold above list price in March 2021. Just take a gander at this. So even in Wyoming, 33% of the homes sold above list price. Take that in. And here's the stunner. Look at California, 60%. Sold above list price. We're hearing that, real estate's only good in some areas. I've been kind of bragging about Nashville and saying that things are great here. And things are great here. But there are other areas of the country. In fact, most of the country. Take a look at this map again. This is good. This is good for the economy because it means people have money to spend and they're willing to pay up for a house that they want. Okay? Crypto Corner. What is going on in crypto? Well, what isn't going on in crypto? This is pretty cool. So China has created their first digital currency. It's a first for any major economy. So if this is a guy's cell phone, and that's what it looks like, he's buying something, for 5.501. So the way this works out is that a Cyber One gives Beijing the ability to track in real time what its citizens are spending. That sounds like Big Brother to me, doesn't it? Okay. This is the attraction to Bitcoin and Ethereum and other cryptocurrencies, that the government doesn't have a way to track them other than to follow the price just like everyone else, but they can't follow the transactions because they don't have the blockchain. But if a country creates its own digital currency, they are watching every nickel you spend. It's one thing when your bank knows what you're spending, but when your government knows what you're spending, if you're like me, you're going, I am not interested in that. But it doesn't surprise me that China is first to the game on this, okay? So in this last quarter, Bitcoin finished up 30%, its sixth consecutive month of double-digit positive returns. It's an incredible time right now to be in Bitcoin and Ethereum and the other major, and some, to some extent the alternative, but certainly the major cryptocurrencies. But this is the fun news I have for you tonight. So the first lobbyist group has now formed. Square, which is one of our holdings, Fidelity Investments, you know who they are. Coinbase, which is an exchange that is getting ready to go public. And a quick sidebar, I had someone ask me this week, I really want to buy Coinbase as an IPO. And I said, I wouldn't touch that with a 10-foot pole. We have no idea what they are worth. And if you want to do that, I guess it's less expensive just to buy that rather than flying to Las Vegas and work on the slot machines. But I would not invest in Coinbase. But still, you add those three together and they are forming the first lobbyist organization planning to open Washington offices to lobby for fair treatment from the U.S. government from cryptocurrency activity. I'm not going to weigh in any more than that, other than just saying that this is another step towards legitimizing cryptocurrencies. And I'm not talking about government digital currencies like the Chinese, but free market cryptocurrencies integrating into the U.S. economy. I find it really exciting. I really do. So I mentioned about the Coinbase IPO. We'll let you know what happens when it goes live. The cryptocurrency billionaires were declared this week. Cameron and Tyler Winklevoss, who were settled. They got a settlement from Facebook, of course, when they left the company, and they turned that $65 million into $3 billion. A guy named Michael Saylor at MicroStrategy, and just a lot of billionaires. What's the point here? What's the PI, the portfolio impact? Currency risk is something that many people don't think about, but the reality is that we have currency risk. If we invest in a company in Great Britain and the pound sinks, even if the company is doing well, if the country's currency is not, we're going to lose money. So we're following all of these asset classes to help you guys. Okay, that's what we are here to do. So, where do we go now? All right, so because of the time, I'm really trying to get you guys out of here at 45 to 50 minutes tops. I'm going to postpone American energy and postpone investing in post-COVID America. But I have some exciting news in that we have our first commercial tonight. Well, okay, it's not really totally a commercial. What it is a promo piece that my producer put together where we're trying to get people on our program. We want to have interesting guests, and I am super excited to tell you about our guest on May 20th. I'm not going to announce his name yet, but he is going to bring an insight that you guys cannot imagine. Growing up in Russia, immigrating to the U.S., and he definitely has opinions on this globalist world order as opposed to the economy that is here in the U.S. But I want to play this little commercial, and if you know somebody that this might appeal to, please let us know. We're very interested to hear from them. Hey, my name is Charles Brown, and we have a live weekly webcast where we talk to guests about what's going on in the world of investment opportunities, market trends, and even politics. Now, we have people from all different backgrounds on the program, so if it sounds like something that you'd like to contribute to and get in front of a live audience, we'd like you to be on CB3 Live in Season 2. Just click the link below, fill out the information, and we'll get in touch with you, and we'll see you on CB3 Live Season 2. All right, guys, in the chat box here, Nelly, now hiring signs almost every place. LinkedIn is just jamming with job offers. You know, it supports the data that I'm showing here tonight. Brian, your bank knowing where what you're spending is a very short step away from government knowing. Well, of course, the bank knows anyway because they're always the intermediary when you make a credit card payment or charge. You know, they're going to find out. Whether they're monitoring it, I don't know. But that's one of the things that's attractive to me about having cryptocurrency is that I can transact directly with another entity from my account to their account. And there's no government entity that tracks that payment. I like that privacy. I really do. Tommy, and you know, I feel bad. You asked me about HBAR and crypto. It's an emerging currency, not currency, but a coin. And I can't find enough information on it. I generally have a minimum threshold for coins that are on the radar. It's not a coin that's traded at Kraken or at Coinbase, which are two exchanges I use, and also crypto.com. But I promise when I get some information on this, I will post it on this program. Okay, thanks for asking. All right, so if we look back at what we looked at tonight, I'm just going to give you guys one more chance to ask any questions. In the COVID area, there's all kinds of progress being made there with new vaccines. There is a new strain coming in, but I don't see that as an issue. In U.S. policy, the biggest thing on my radar is what's going on with the Biden administration and this awful $2 trillion package for infrastructure. I just wish it was pure, real infrastructure. In the world economy, we broke down into these 6 groups, the weekly market review, and this time it was a full review per quarter basis. The next time I'll do this, guys, will be after the 4th of July. We accumulate all the data there for the second quarter. Feature stock was Google. Economic indicators, giving you an idea what I'm looking for in the second quarter, the things that will drive growth. The Fed, kind of quiet this week, but basically saying, we see justification for the stimulus package. We think it might help continue to abate the labor shortage problem. U.S. housing market continues to be on fire in that people are paying more than list price at a greater time than any time in my lifetime. Crypto corner, interesting about the Chinese and their intra-country, currency there. We'll see where that goes and put off American energy and investing in post-COVID America for a little while just because so much is going on. If you've got any questions, type them in here, but just basically we'll go back here and close with my regular slide. In summary, from 2 Timothy, we have not been given a spirit of fear, but a spirit of power and love and a sound mind. It remains my deeply held belief that we will not only survive this pandemic and 2021 in general, we will emerge a stronger people and nation. Really appreciate you joining me tonight. It's good to be back. We plan to be back here next Thursday. All we can do is plan, right? So just know that anytime during the week, if you want a copy of the slides, send me an email, cb3@cb3.com. I'm happy to send it to you. You can always mention this program to your friends. We'd appreciate that. Friends, family. We're trying to increase our audience. We think we've got a pretty honest program here, telling you a lot of good information every week and actually a pretty good track record too. So if you know somebody that maybe is not happy with their investment manager and wants to talk to somebody, we're getting new people from the show, and it's exciting from around the country. But we'd love to talk to your friend or family member if we could help them too. So it is Thursday. It is April 8th. I'm Charles Brown, live from Nashville. From COVID, U.S. policy, and the world economy to clarity, this is CB3 Live. And as I always finish the program, we don't just manage your assets at CB3 Financial. We become one of them. We'll see you guys next time.